And good morning. We are live, so to speak. Well, actually, it's not live. This is pre recorded coming to you because, as I have mentioned, I am actually away enjoying a little bit of peace and quiet, hopefully. So, today actually is Thursday, at least. Well, it is Thursday actually because I am recording this on Thursday. So, it's just that it's not going necessarily live. In today's episode, we're going to be covering updates on real estate. As you know, typically on Thursdays, we do real estate updates, and today is no different. So, we're going to talk about a little bit about interest rates, mortgage defaults, or what's going on there. Is the market going up, down, sideways, and what does that mean for you? So, hopefully, you're going to enjoy this. If you're watching this on YouTube, which I'm going to guess that you are, do me a favor, hit the like button, do subscribe, hit the bell button, get notified every day that this goes live because 99% of the time, unless I'm away or ill, we go live at 7 a.m. on onedealaway.com. All right, y'all, let's do this. And good morning, good morning, good morning. I hope you're doing excellently on this Thursday morning, July 16, where we're going to go in and cover and talk about real estate stuff. So, let's jump right into it. And of course, the first thing that we got to cover is mortgage rates. And that is for a reason because vast majority of real estate is connected to the mortgage rates, which is connected to unemployment, inflation, and interest rates. And it gives us a nice sort of big picture of where we are and where are we going. So there's a nice article, a very, very short article that has been written about it. And of course, it comes from Bankrate. Uh, we're going to basically just look at the rates and understand of what's going on. Where are we? So 30-year fixed mortgage is 3.14%. This is an average. So this is, you are going to see some higher, some lower, and a lot of that stuff is going to depend on your personal credit rating and, of course, who your lender is. So it's a combination of the two, but this 3.14 is really an average and it's a decrease of 7 basis points. Now, we do have reports and have reported last week that there are plenty of mortgages that are well below 3%, not 2%. Sorry. Woo! That might happen in the future, but not today. Not today. So, and then of course, a month ago, average was 3.42%. So as you can see, we are actually going down. What that tells us is that there's a couple of different things that this tells me. When we know that the mortgage is connected to the interest rates, it means, and interest rates are connected to the inflation, and lower the inflation, lower the interest rates, right? That means that the inflation is actually getting even lower, contrary to the popular belief that everybody keeps on talking about, and that is that inflation is running higher. Now, inflation is higher for some of the products, typically food, cleaning supplies, like daily living supplies that you need. Of course, medical has been going up through the roof over the last, I don't know, decade, maybe 2 decades. And of course, the asset prices. Because of the money printing, money is going into the assets, or at least it has been. And so that's kind of where we see this. So inflation is on the lower end, which is why we're seeing a drop. 15-year is also down, but only slightly. It's 1 basis point, and it's at 2.72% on average for this week. 5-1 arms, which is the non-fixed rate, the fluctuating rate. My gosh, my brain has stopped working. It's the adjustable rate mortgage. Sorry about that. Is 3.19%, which is adding 8 basis points. Now, this is an interesting piece over here, and I always enjoy seeing this stuff. When you see arms that are actually at 3.19, right, and then you see fixed is at 3.14, what does that tell you? What that tells me that they are expecting that the rates are going to go down, because the arms are basically typically what they do is they will try to get you in at the lower beginning of it and then adjust up so that the lender can make money. When arms are low, sorry about that, when arms are lower, when arms are lower than the fixed, that makes sense because they will get you in at lower and then fix you up, or adjust you on up, and you're going to be paying more than the fixed rate. When the fluctuating rate is actually higher than the fixed, that means that they don't see, bankers don't see the perspective or ability for them to increase it up. And the fact that it actually went up 8 basis points, not down, lets me know that the more likely than not, we can expect that at least in the short term, if not the long term, rates will continue to go down. So that's kind of where I expect that things are going to be. And here we can take a look at nicely of sort of what the average month mortgage interest rate is, and you can see right here the current week, and then you can see the last week. And as you can see, all of the fixed has actually gone down. And the interesting piece to me is that the 30-year fixed and 30-year jumbo and 30-year fixed refinance are both at 3.9, as well as the arm, which they haven't listed here. But there you go. That's kind of what I expect. And of course, they're saying, lock it or do whatever. And they're trying to sell you into the product and stuff. But I think you can definitely make your own decision as to what you should do. Because when you start looking at some of this data and you start understanding what is going on, then of course, it makes sense for you to make your own decisions and not rely on the banker to tell you what's the best for you, because banker will always tell you what's best for the banker, right? Salesperson is always going to tell you what's best for the salesperson. So you want to make your own decisions, and that is the reason why we do this show. Why Money Matters exists, why One Deal Away exists to begin with, is to help you start thinking for yourself so that you don't have to rely on me or anybody else whatsoever when it comes to making decisions that are very, very important when it comes to your money and life. Because while money and life are not the same thing, and they are closely correlated, and you definitely need money for life these days. I wish it wasn't so, but those days have left a long, 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 long time ago, well before you and I came on this earth. So then we have a new article over here, and it says, it starts, mortgage delinquencies suddenly soar at record pace. So it's interesting. You're going to get some, before we go into with this one, I want to tell you that you're going to get some very conflicting information here, and you might walk away from the show being confused and thinking, I don't know what to think or what to believe. But I think when you look at a confusing and conflicting information, you can start then parsing it out for yourself and start thinking a little bit deeper. Because it's very easy when somebody tells you one thing and you're always hearing the same agenda, it's very easy to follow into that rut and follow that agenda, whether it is correct or not. When you start hearing conflicting information, you almost kind of stand on top of a mountain and you see what's happening on both sides of it, right? When you're only on one side of the mountain, you don't know what's going on the other side. And so your reality is very constricted. But when you stand on top of the mountain, you can kind of see all the moving pieces. Now that's a very different component and perspective, and it gives you much deeper perspective, which is why we do this stuff. Okay. Now that we explain, you can actually mentally, emotionally prepared that this is not going to be one-sided thing, that we're going to get a little bit of everything, kind of mix it up, and then you can walk away really thinking of what does this mean and what does this mean for me? Because, it's one thing to get a global perspective, but it's a completely different ball game when we're talking about perspective for you, all right? So mortgages that are in forbearance and have not missed a payment before going into forbearance don't count as delinquent right now. They are reported as current. And as such, when they do report as current, then you're not going to see them in all of these reports of the delinquencies that are being officially reported, because they are right now being held as current. And it's only after they don't, right? Like after the current agreement expires, or whatever ends up happening, that you will start to see those numbers. So what that means is that we're going to see this delay in what's going on. So we're not getting the full real picture right now. We're going to get it with a delay. There are also a report that says 8.2% of all mortgages in the US, or 4.1 million loans, are currently in forbearance. I want you to remember this number right here: 4.1 million loans. It's important. Onslaught of delinquencies came suddenly in April, according to CoreLogic. In April, the share of mortgages that were past due but less than 30 days soared to 3.4%, right? So you can kind of see the nice chart of kind of what's been going on. And you can see what's been going on here with the 30-day, current to 30-day transition rate. Here is the part of what happened in the 2007, 2008, 2009, right? The last crisis that we had. And you can kind of see what happened here. So we've definitely broken yet another record in this really, really weird time of our lives, honestly, of the decade, of the century, perhaps. From 30 to 59 days past due, delinquencies up 4.2%. 60 to 89% days past due, this stage has not impacted yet. So it's still staying low at about 0.7%, which is the normal. And this is the stuff they've been measuring since 99. So that's pretty much the average. So it's a normal piece. And this stage, they're saying, is not going to show up until for about a month from now, when we have this 30 to 59 day move into 60 to 89 day past due, right? So when you see, right, it kind of makes sense that you go from, 1 month, 2 month, 3 month more, that it kind of shifts over the month. So they're saying that we won't see this for about a month from now. So that means mid-August, roughly, or so. Serious delinquencies, 90 days or more past due. Again, stage hasn't been impacted. The rate ticket down to 1.2%, which is the normal that was 1.3 a year ago. And we should see this come in 2 months from now. So September-ish is when we should see this. So August, we're going to see this change, and it's likely going to go up, because unless a majority of these people can pay, which I don't see that happening, because there's not much changing in the world as a whole, we can see that 60 to 89% past due will actually go up, probably right around 4% or so. Because if you take a look at here, that this has actually gone up, this has gone up. I do predict and expect that in about a month, when this actually hits, that it's going to go up. So we're going to see a jump here as well. Overall delinquency rates, 30 plus days, jumped 6.1% from 3.6% in April last year. Now, this is a very, very big jump, of course, and it makes sense if you think about it, because you have all of those people that have lost jobs. People cannot, pay for things. Those that have jobs, maybe their income has been cut. Those that are unemployed, maybe they're not getting all of the benefits or don't qualify for any benefits. So there's a slew of challenges and issues that are happening. But we, of course, also have reports and know that there are people that are in forbearance because they can, not because they have to. And so they are using the money, hopefully wisely, while they're not paying their mortgage. But we'll see. Typically, when people make these decisions to say, I'm not going to pay if I don't have to, typically those people also tend to make some not so wise choices. Not everybody, but many of those people make not so wise choices. And so they end up using that money to live lavishly, until the calls start coming in and you have to pay, and then you find yourself in potentially hot water, as I like to say. So delinquency hotspots, no surprises here: New York, New Jersey, Nevada, Florida, and Hawaii. Uh, I don't think anybody is surprised or shocked with it. New York, New Jersey were very hard hit. Nevada is very dependent on the visitation gambling and that kind of stuff. Florida is very dependent on the tourists and the folks kind of moving in. And there's a lot of secondary homes that are in Florida. And if you have two homes, two mortgages, things are hitting, you're going to keep your primary residence and say, forget everything else. I got to focus. So there's no surprise there. And then Hawaii, again, depends largely on the tourism as well, which has been hard hit in potentially some secondary homes from folks living on the West Coast. Worst hit metro areas are, again, tourism destinations. And they're saying that New York City was, the most devastating with the pandemic, which of course everybody knows that. Miami, Florida, Kauai, Hawaii, New York, Atlantic City, New Jersey, and Las Vegas, Nevada. And again, it makes sense when you really think about it. With over 8% of mortgages now being in forbearance, there's a lot of uncertainty. Core logic expects to see a rise in delinquencies in the next 12 to 18 months. And this makes perfect sense to me as well because you don't see this stuff. The interesting piece about real estate is that it moves much slower, and so you get sort of the older data. And so when things hit, it hits first into the employment and the liquid markets, such as stocks, money markets, bonds, gold, cryptos, and that stuff. And then it kind of spills into businesses, and then it spills into real estate, because real estate is sort of the on the back end, the backbone of the whole thing. So there's one report that, as you have seen, is very uh, negative, I would say. I think it's realistic, but very negative in what they're having to say. They're not predicting anything crazy. I think that they're just sharing what the reality is, and I think that that's very, very important. Now, we have a different report that talks about the share of mortgages that are delinquent. You can see the same thing. It was up in April, and we're going to scroll down. I promise I did highlight. I do think that we're going to see further increases. I do think we're going to see further increases in delinquency rate year from now if the economy hasn't improved substantially by the time forbearance runs out. You could be looking at a prospect where the lender begins foreclosure proceedings. And of course, here's the share of mortgages that are at least 30 days delinquent, and this is April. And as you can see from this chart, in April, we're looking at what? Mississippi and Louisiana as the only ones that are on the higher end of things, right? Everybody else is sort of on the yellow side. Of course, West Coast is, like not much kind of happening, right? Like on the 2% level. And then as we go into the April, you can see that, of course, Louisiana really jumped in then. And that, can I kill this? Yes, I can. Excellent. And then you can see that New York really spiked up, and we're seeing that a lot of the East Coast, kind of the South, was following the virus. And so if that is the case, right, then we can expect, as the virus kind of went this way, that it would kind of follow the suit and go with it. But now that we're seeing reemergence of virus and like all over the place, with the exception of New England, that is sort of jumping back up kind of all over the U.S., we can see that shifting again. It's given this sort of second wave of things, especially as they start reclosing things again. We could see this having a much larger impact. And again, this would add things on. So if we're in July right now and we kind of add about 3 months, so we're talking April, sorry, I don't know how I jumped into April, August, September, October. So we're looking at like October, November when we're going to see this additional spike potentially. So that's something to really, really watch out for. So I think that there's going to be a lot of things to see, and a lot of uncertainties coming our way come fall into winter, which I have been calling for a little while. CoreLogic model forecasts serious delinquencies rate will quadruple during the next 18 to 24 months, meaning about 3 million borrowers could be at risk for losing their homes. Great Recession, almost 4 million homes were lost to foreclosure between 2007 and 2010, right? And now they're saying about 3 million. But remember, I also share with you here that right now we have 4.1 million loans that are in some sort of forbearance or default, so to speak. So interesting piece is to remember that there was that 4.1. They're saying 4 was in the last recession. They're saying maybe about 3%, but I am actually thinking that that is going to be much higher than that for the reasons that I just explained. That there's this shift kind of happening, and unless something larger comes out from the government, and unless there's these new repackaging and remodeling and that kind of stuff that happen that sort of help individuals who are in forbearance have ability to kind of hold on to their homes. I do see this that it's going to be much larger than 3 or 4 million. I actually expect that to go even higher, but that's just me, right? So there we go. The housing market looks strong for now. There were 22% fewer homes for sale during the week ending July 4th than they were the same time last year. Steady demand from buyers and home prices are still climbing because you have a high demand, low supply, prices have to go up. If delinquencies lead to foreclosure as the forbearance time expires, we could see an increase in the number of properties on the market, which means that they're going to be distressed and prices are going to tumble. There's estimates that the home prices will fall about 6.6% from this May to next. Freddie Mac forecasts flat home prices next June, so June 2021. And Redfin's CEO Mar, while optimistic, also says falling home prices are possible. The future of the housing market ultimately depends on how quickly the coronavirus can be contained, which I think then drives the stimulus and the employment and all the other components that kind of come with it. The risk of massive wave of foreclosures is pretty low right now, and that is coming from the Redfin CEO. But I am basically saying that this all also very much depends on what happens with the virus, with the economy, and what the Congress does and what the government does, and the willingness of the banks to work with the lenders, and whether they are going to be restructuring stuff and making it easier for people to stay in. We'll see. I do think that there's going to be some massive changes that the banks will have to make changes because if you have so many borrowers that cannot pay and you are the banker, if you have 10% of your borrowers that can't pay, it's easy to foreclose because they're buyers on the other end, and so you can recoup your money. If vast majority, 90% say of your borrowers cannot afford to pay, you don't really have an option but to work with them, because if you don't, you can foreclose on them, sure, but who is going to come and buy? There's not going to be buyers coming on the other end. So I think that they will have to rework something. I just don't know what that something is at this moment in time. So that remains to be seen. And then final report that we have, it's official. The U.S. won't be seeing a housing bubble crash anytime soon. So there you go. That is interesting one. This is coming from Logan, who Matashami. I apologize if I have butchered the name. Mr. Logan, housing data analyst. So he's saying that my long-standing core thesis has been that the housing market would have been weakest recovery from a crash in the years 2008 to 2018, but it would improve in years 2020 to 2024 because of the demographic would become favorable for housing. Now, interesting piece that he said, weakest recovery from 2008 to 19, whereas we did have actually pretty dang good recovery, very strong recovery in all markets, including the fake ones in the Wall Street casino. We should see 1.5 million total housing starts, and the purchase application index will get over 300. This was, of course, pre-COVID, and so that is going to shift things. Based on my model, I told everyone to wait until July 15th before drawing any conclusion. The Mortgage Banking Association purchase application data for the last 7 weeks on a year-over-year basis looks like this. plus 18%, plus 13, plus 21, plus 18, plus 15, plus 33, plus 16. As you can see, plus, 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 it has been going out. So purchase applications over the last 7 weeks has been up. Sales were up 44% month to month, and purchase applications of new homes up 54% year over year. This is important to understand. In the future, home prices will fall and sales will decline year over year. But when this happens, it will not constitute a bubble crash anytime soon. And I think he is right. I think that the future prices will go down. People will go in. I don't know. A crash, maybe, potentially. I don't know. We will see. But he's saying he doesn't think that is going to happen. What he's basically saying is that even with the COVID happening and all of these uncertainties, that his prediction is that you need to refocus on the factors that really matter. Demographics, mortgage rates, national progress to conquer the virus, reopen the economy, and get people working again. And I agree with that, but I also have been telling you, and I still believe that the jobs are not going to come back as quickly as people would want them to or think that they will as things reopen. So I think that that leaves still a very large number of people unemployed. And again, depending on what Congress does next week, potentially, I don't even know if they're going to be able to pull it off. Allegedly, they're going to start working on it next week, but I don't know if they're going to be able to pull it off. It's going to depend, and that is going to have an impact on real estate and kind of what happens, September into spring and fall of 2021. So that remains to be seen. So we got to watch out to what people are doing, what Congress is doing, and what's happening in the economy as a whole over the summer months. Okay. So that's important. As long as purchase applications data stays flat to positive on a year to year basis, housing will be fine in 2020. And I agree. I think we are going to be okay for right now as far as the prices. But the challenge comes in is that you don't want to buy when the prices are going up, right? You want to buy when the prices are down, and you want to buy below the market, not necessarily at the heap of it or getting it the top price or anything. Because when you get the top price, it only goes one way, right? When we hit that sort of peak, it has to go down. Everything is cyclical. Real estate is exactly the same way. So right now, I still stand behind my thing that the best thing to do right now is to sell and hold, right? If you have good real estate, if you have it, if you gotta get rid of it, now is the time to do it. If you have real estate that is doing a good job with cash flowing in areas where people want to move and live in, it makes sense. If there are areas where you want to move and go to, it might make sense. But for me right now, the lowest risk real estate that there is to buy are going to be what is known as distressed properties, what I like to call as properties that are high value properties. And those are properties that give you an ability to go in, buy it at a deep discount of 90% discount or so, and then it doesn't matter what happens with the market, y'all. It really doesn't matter because you purchase something worth $100,000 for $10,000 or less. Even if the market crashes 50% or 70%, you are still up. And that is the key to investing. You want to buy below the market price. So it doesn't matter what ends up happening. All of that stuff ends up being noise. You are still doing well. And that is the key to me to investing in real estate. And if you don't know how to do that, I invite you to come check out some of the information and courses that we have at One Deal Away. And so thank you for watching. This is today's episode. Hopefully you have enjoyed it. Hopefully you have learned something great. Hopefully you will do something amazing this weekend. Go and relax. There will be another video coming tomorrow that is going to release on YouTube channel. It's of course going to show up on onedealaway.com as well because we broadcast. When we broadcast live, we put it on YouTube. When we put stuff on YouTube, it comes back to onedealaway.com. So either way, where you want to watch, come and watch it. Tomorrow we're going to discuss crypto, and then we're going to take a break for a couple of days for everybody's sake, including my own personal sanity. I hope you understand. And until next time, Stay forever money blessed. And do remember, you are only one deal away. Bye, y'all.